In 2008, the global economy collapsed faster than anyone expected. Trillions vanished almost overnight. But the real mystery is how it all started. This wasn't just a market crash. It was a failure of trust, oversight, and assumptions. To understand it, we need to go back. The dot-com bubble had just burst. The US economy was slowing fast. Fear of recession pushed policymakers to act. The Federal Reserve slashed interest rates repeatedly. Money became cheaper than it had been in decades. Borrowing suddenly felt effortless. At the same time, home ownership became a national goal. Owning a house was sold as the American dream. More buyers were encouraged at any cost. Banks rushed to issue mortgages. Standards loosened with every passing year. Approval mattered more than ability to repay. Credit history stopped being important. Income checks became optional. Risk was quietly ignored. These were called subprime mortgages, loans designed for borrowers already struggling. They spread faster than anyone realized. Some loans required nothing at all, no income, no job, no assets. Yet approval was guaranteed. Behind the scenes, something else was growing, a shadow banking system outside regulation, big risks, no safety net. These institutions borrowed aggressively. They used massive leverage to boost profits, and almost no one stopped them. In 2004, key leverage limits were removed. Banks could borrow almost endlessly. They believed risk was under control. Banks didn't keep these risky loans. They bundled them together and sold them. Risk was transformed into a product. These bundles were called mortgage-backed securities. Thousands of loans merged into one asset, safe on paper, dangerous underneath. Then came even more complex products. CDOs mixed good loans with bad ones. Complexity created the illusion of safety. Wall Street loved these products. They paid high fees and promised steady returns. Demand exploded worldwide. Rating agencies were supposed to warn investors. Instead, they approved almost everything. Their models ignored real-world risk. Banks paid the agencies rating their products. Higher ratings meant more sales. Objectivity quietly disappeared. Pension funds, insurers, and banks bought in. Everyone trusted the ratings. Few questioned what they were buying. The logic sounded convincing. Spread risk widely and it disappears. But garbage stays garbage. By 2005, the housing boom peaked. Prices rose faster than incomes. Reality was falling behind illusion. Interest-only loans became common. Borrowers paid nothing toward principal. Debt quietly piled up. Foreign investors rushed in. US housing was seen as unbreakable. The money flood felt endless. In 2006, the yield curve inverted, a classic recession signal. Few wanted to listen. By 2007, home prices stalled. Then they began to fall. The system depended on endless growth. Defaults surged across the country. Millions couldn't repay their loans. The dominoes started falling. Those safe-looking securities collapsed in value. Losses spread across balance sheets. Trust vanished quickly. Banks and insurers faced massive losses. No one knew who was exposed. Fear froze the system. Subprime lenders failed one by one. Foreclosures surged nationwide. The crisis went public. If this is making sense so far, pause here. Like the video to support this channel. Comment what surprised you most. In early 2007, cracks became collapses. Major institutions started to wobble. Bear Stearns was first. 2 Bear Stearns hedge funds collapsed. They were filled with bad mortgage debt. Wall Street panicked. Markets realized something was wrong. Losses spread faster than expected. Fear replaced optimism. Banks stopped trusting one another. Interbank lending froze. Liquidity vanished. The Federal Reserve stepped in urgently. Emergency liquidity flooded markets. It wasn't enough. Subprime defaults surged nationwide. Foreclosures spread street by street. Housing values collapsed. Losses hit pension funds and insurers. Ordinary savings were now exposed. The crisis reached everyone. By March 2008, Bear Stearns was near death, one of Wall Street's oldest firms, gone in weeks. The Fed brokered a fire sale. JP Morgan bought Bear Stearns cheaply. Taxpayers guaranteed the risk. Next came mortgage giants, Fannie and Freddie. They backed half of US mortgages. They were failing too. In September 2008, the government intervened. It seized both institutions. Collapse was narrowly avoided. Attention turned to Lehman Brothers, deeply exposed to toxic assets. Time was running out. No buyer stepped forward. The government refused a bailout, a historic decision. On September 15, 2008, Lehman collapsed, the largest bankruptcy in US history. Markets froze instantly. Panic rippled across the world. Trust vanished overnight. Fear ruled markets. AIG was next. Its insurance bets were imploding. Failure would have destroyed the system. The Fed stepped in again. An $85 billion rescue was approved. Collapse was postponed. Credit markets stopped functioning. Businesses couldn't borrow. The economy stalled. Congress rushed emergency legislation. A massive bailout was proposed. Failure was not an option. The $700 billion TARP program passed. Banks were recapitalized. Public anger exploded. People felt betrayed. Banks caused the crisis. Taxpayers paid the bill. Markets collapsed worldwide. The Dow fell nearly 40%. Wealth evaporated. Credit dried up completely. Businesses failed rapidly. Layoffs followed. Millions lost their homes. Millions more lost jobs. Lives were shattered. The crisis spread globally. European banks were exposed. No country was safe. Iceland's banking system collapsed entirely. An entire economy imploded. Shockwaves followed. Markets fell 40 to 60% worldwide. Trade collapsed sharply. A global recession began. World trade shrank nearly 10%. Global demand disappeared. Recovery felt distant. Central banks acted together. Rates fell near zero. Unprecedented intervention followed. The system stabilized slowly, but damage remained deep. Trust was broken. Unemployment surged across the economy. Nearly 9 million Americans lost jobs. Recovery felt painfully slow. Millions owed more than their homes were worth. Foreclosures reshaped entire neighborhoods. The damage lingered. The recession officially ended in 2009. But for many, it didn't feel over. Scars remained for years. Governments faced hard questions. How did oversight fail so badly? And how to prevent another collapse? Interest rates were slashed to near zero. The Fed expanded its balance sheet massively. Unconventional policy became normal. A massive stimulus package followed. Trillions were injected into the economy. Growth slowly restarted. Regulators moved to reform finance. Stricter rules aimed to curb excess. Oversight returned. The Dodd-Frank Act reshaped banking. Stress tests became routine. Consumer protections expanded. The Volcker rule limited speculation. Banks could no longer gamble freely. Stability became priority. Globally, new rules emerged. Basel III forced banks to hold more capital. Risk tolerance dropped. Markets eventually recovered, but it took years to regain losses. Patience was tested. Households rebuilt cautiously. Debt levels stayed under scrutiny. Trust returned slowly. Public anger never fully faded. Bailouts raised moral hazard fears. Accountability felt incomplete. Complex products failed spectacularly. Models underestimated real-world behavior. Correlation was ignored. If this breakdown helped you understand the crisis, engage now. Like the video and share it with others. Tell us your thoughts below. The crisis wasn't one bad decision. It was an entire fragile system built on false confidence. Wall Street believed risk was solved. In reality, it was buried and waiting. Lehman wasn't the cause. It was the trigger. The first domino. Housing cracked one market. The world felt the shock. Everything was connected. Deregulation needs guardrails. Oversight cannot be optional. Complexity demands caution. Innovation isn't the enemy. Blind trust is. Understanding matters. If something feels too complex to fail, pause. That complexity hides risk. Transparency is safety. Rules changed after 2008, but memory fades. Vigilance must remain. The crisis reshaped modern finance. Its lessons remain relevant today, especially now. The 2008 crisis was preventable. It exposed systemic flaws and changed history. Thanks for watching this investigation. Subscribe for more stories about money and power, and like the video to support the channel.